Welcome, everyone. I'm Greg Schnell, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on stock charts, we'll be looking for long time frame trades. Please subscribe to my articles and Twitter feed. You can also enter comments in the chat room for me to answer at a later date. We have lots to talk about since last Friday's disruption, actually since Wednesday's disruption. So we're going to cover that off and go through that. So the big thing I want to talk about, does China make rattles? And I posted in the chat box there that Megan and Harry have their new baby, and it's a baby boy, but are we looking at a rattlesnake for the markets? China tariffs started the tops in January 2018, and there's an article from Reuters that goes back through the history of how these tariffs are started up. And basically, it was January 2018 that tariff talks started. And so here we are a year later, a year and 3 months later, and we're still talking about tariffs. And of course, the Dow Jones Composite hasn't taken out that high yet. And the other markets are still, I'll call it, near their prior highs or slightly higher. I think most of them have pulled back below. So far, the Fed meeting has topped the market. That was the day again, and I'll show that chart as to why I think that's important. And then breadth, we're going to talk about breadth specifically today, and there's a good reason for that, and that is that lots of them are starting to fire little sell signals here and there. But there's one big one from McClellan that continues to hold a higher standard, and it's one that I want to show as an offset to all of the ones I've got. So that's important. And then commodities are drifting lower. And so if global demand was sliding for everything, from copper, steel, rare earth metals, aluminum, oil, you name it, usually that doesn't mean we're about to enter this next big phase of growth. So that's an important consideration, that they're all dropping together. And the global charts add to the weight of the caution. And what I mean by that is all of the major market tops, when you go back and look 2000, 2007 and all of that, they were worldwide. They weren't just a US market top. And so the issue is where the momentum. So one of the things I look at, probably different than 100 of the other analysts you might look at, is how I read the PPO. And so we could probably talk a lot about that specifically, but I'm going to try and just lay out a couple of charts that make this particular point very cautious for me. Now, it doesn't mean that it doesn't all work out roses and and we don't end up with a new winner here from the Kentucky Derby or something, but I think there's a lot of charts that just yell caution to me, and maybe that's just pessimistic, but the last thing is that Congress still hasn't weighed in on the NAFTA deal, and so there's a NAFTA kind of done deal, and we still need Congress to approve it, and they've said that they want way more input in that. So even if we started to work with the Chinese and get something past the White House, we still have to get it past Congress. So let's be real focused on what's going on. And then the other thing is the global PMIs are all starting to slide. So there's more than a host of reasons to pay attention here, and I want to make sure. I just heard a couple of guys on TV, and it was like, this is no big deal. I want you to look right through this. We're going to get a deal done, and everything's going to be great. And the real concern is, while that might end up happening, the charts are set up. If failure happened here, we would look in the rearview mirror and just say, geez, how come we couldn't see that happening? Anyway, so I want to go through those charts and talk about it specifically today, because we are starting to get this similar topping structure that we've seen on the previous declines. And if so this is the Fed meetings across here, and the black lines are Fed increases. And the problem that we have with these market tops that have come at the Fed meeting, they've also come on other news or whatever. Like this one was the NAFTA top. This one was the introduction of tariffs. So all of these things are coming forward. And it does add up, and it does say major caution. And there's a really nice tweet out by Fisher Investments, and their comment was, if it's not a $3 trillion issue, don't worry about it. The market will bounce back. And my main concern is that the charts are set up for a lot bigger than a $3 trillion issue. So at least let's be aware of the potential for upside or downside. So I published this article just the other day. This is both composite indexes stall at resistance. And the point I want to make is that as these indexes stall as a group, so here's the New York Composite. And again, this one is making lower highs. And I think we've all been aware of it, but Jeffrey Gunlatch brought it up yesterday. And I continue to think it's one of the weaker indexes, but more importantly, it's also one of the indexes that rolls over first. And so what you'll probably find is your portfolio is dropping even though the S&P is making higher highs. Then here's the Russell. And the big thing about the Russell is this 1600 level has been a pretty major frictional layer. And the one thing I will point out here is that on the January high, it ran up just like it did now, and then it rolled over. And then on the August high, it was kind of in a downtrend, ran up on the final acceleration and rolled over. And so it pulled back here, running up on the final. If this was the final, it's running up right here. So it doesn't, just because the Russell is starting to outperform or perform well, we saw that in the other tops as well. So I wouldn't don't let that, the Russell's starting to outperform, so that's bullish, everything's getting better. And then lastly, here's the Dow. And the big thing about the Dow that I want to point out is obviously this was a parabolic run. And these are the Alexander Elder candles from stock charts, and you can get to them if you go and pick your display type and then pick, rather than candlesticks, go all the way down to the very bottom and pick Elder. It'll give you the red, green, blue. On here, you see this huge move, and it was awesome. I mean, it was just straight up. And then it literally fell apart. And then we got back up to the same level, tried to hold it and couldn't, and it fell apart. And what you'll notice is the momentum into this second one, albeit stunning. I mean, this was quite a move. The PPO showed a lot less momentum. And now the concern I have is look at the momentum slope from this high in February to this high here as we approach the prior highs. So there is a lot of technical damage that is going on here. And again, the bulls will bring out the SPX and the NDX, and I agree. But there's a really good point made that 6 of the stocks in the NASDAQ 100 make up 280 or 290 of the stocks in the S&P 500. So, and 50 of them make up half of the S&P 500. So we're really at a nifty 50 situation. And for those that don't know what the nifty 50 was, it was over in India for a long period of time. They went through this period called the Nifty 50, where you just owned the Nifty 50 because they would buy up everything else and they would be the greatest stocks to own, and it was going to be great. And it just kept going, and then it blew up. And so anyway, we have a bit of a Nifty 50 situation going on where everybody needs to own tech because all of the other areas of the market haven't been performing up to that standard. Okay, so I mentioned that there's some issues globally, and the point I want to make really, really clear. So this is the way I read the PPO, and we could use this high, or we could go back and find prior highs to work with. But this does a good job of setting up the dynamic. So as we're heading into this high here in 2015, and again, the price of oil collapsed in 2014. So that was something that started to cause the damage. And then the market rolled over, but I don't specifically want to talk about how big the decline was. I want to talk about the setup here. What happened was the market dipped below zero, rolled up, and when it got around zero, it rolled back over. And to me, when it starts to get weak enough that we go below zero on a weekly PPO, not on a daily, but on a weekly PPO, it's at least setting us up for a cautionary tune that this could perhaps be a final high. And so then we pull back down and we roll up, and the market falls apart right at zero here. And you can see this was pretty fast acceleration. It was kind of 1 week off the highs, bobbled for a week, and then literally, kind of the next 6 weeks, it was straight down, bobbled for a couple of weeks, and then finally made the final low. this whole period was 4 or 5 months, similar to what we just went through, and bobbled back up. So one of the things that happened in 2016 was a lot of the trend lines broke and we restarted. And to me, that's where we really started the long-term erosion of momentum on the big uptrend. So we're going to cover that off in a little bit. But then we see this big PPO trend line break here that goes multiple years. And as we break through it, it gets pretty important. But in here, we had literally touched just under zero and started to rally. Now, it doesn't mean it has to be a final high or the next final high. But in this particular case, it did work out that way. We had almost no momentum coming into 2018 September high. And then the market rolled over, and this is the Nikkei. I'm not even talking about the S&P 500. And then it rolled over and pulled down really deeply, and now it's rallied back up to zero. And it's this rally back up to zero that when it fails, it's usually pretty important. So if we just extend this graph out, whatever, 25 years or something like that, and just go look for where we see these dips below zero, usually that's the start of a major downtrend, and we at least want to be aware of it. Here in this particular case, there was a dip below zero, then a bigger dip below zero, then another dip below zero. And these, every time it tested the highs here, these were important places to make sure you were off the train. And so in 2006, we got a dip below zero. The next high might be the final high. Well, it was pretty darn close. If it wasn't the final high, it was right near it. And then we made a lower high, and then we broke down really, really hard. And it's this sudden acceleration lower that I think surprised everybody. And then on a rally here, we couldn't get above zero, and we rolled over, and that was very difficult. We had the same thing here where we had a dip below zero, and then we pulled up and fell down hard. And then we just barely got above zero and rolled over, dip below zero, pull up, fail right at the line and fell down hard. So I'm finding on a lot of weekly graphs, this is a really good, at least, warning. And the RSI does a good job of this type of information as well when it can't get back above 60. So here you have the Nikkei over here, and after it's gone down to 30, it can't get above 60, and that's just a good place to be aware of. So here we are in 2007, drops to 30, bounces up, can't get above 60, and keeps cycling in here. So that's one example. And now if the reason I like the DAX is because it's one of the most active markets in Europe. It's had some of the best growth, and you can see that this 11,750 level pretty much marks support for the Head and Shoulders top that it had. And what we find now here is we've had a big dip below zero, a roll up, and then this was a really meaningful one, and we've come down, and now we've been declining for 2 or 3 weeks here, and I must admit that I thought the DAX was going to roll over closer, but now we're getting it. And we still see relative underperformance from Germany. And with that, there's a lot of things going on behind the scenes. There's not just China. So if we pull up a Deutsche Bank chart, again, this thing is, drilling on the lows and continues to work its way into the lower right-hand corner. And so if we're going to have a problem with European financials that would all of a sudden, quote, surprise us, that would be an issue. And so Deutsche Bank is no small bank. I mean, it is a pretty big entity, and then you've got Commerzbank in Germany, and the chart looks marginally better. But these charts are starting to tell you something, and you can see here's the RSI stuck below 60, and it's rolled over kind of right where we'd expect. So it got down to 30, ran up to 60, and rolled back over. And the fact that it rolls back over is a pretty important place to be aware of. And I'd say we're there. Now, we're not at the end of the week. This is Wednesday. If all of a sudden this thing went ballistic and came back up above, this thing could turn higher. So I drew this red line on here a while ago. The real question is when will it start to go? But even back in June 2018, downtrend in momentum, last low below zero. This might be the final top. And that was a pretty nice call. June 18th written in June, and all of a sudden we break down. So it's not easy, but it's at least a warning to us to pay attention. Now in Germany, we still have lots of lower highs here. So if we go look at Brazil, and the reason I want to look at Brazil is because it's set up, but it hasn't topped yet. And so one of the things that we have here is we have this big low, well below zero. Now it actually cranked higher and continued to push up, and you can see it got up pretty much to the previous area, and now it's pulling back gently. And what we don't know is, will it implode? Will it actually break down? And so, again, it doesn't, just because it dipped below zero doesn't mean that it's always going to fail, but it does suggest that the next top would be your final high. And so we're up here, and now it looks to me like we've got somewhat of a high structure here. We've spent 4 months going sideways while the rest of the world has rallied. And I don't have an answer. I don't know, but I would just say that as a commodity country, that starts to look concerning. I have Russia right beside it. What we see on Russia is we had this big dip below zero. We're now rallying up. My PPO trend line here is just being tested now, but we're almost at zero in terms of the histogram, which would mean the signal line, or the PPO line, crosses below your signal. And we have this structure with kind of a head and shoulders top potential. And so it doesn't mean it's going to happen, but using the tools I've just shown you, wouldn't it make sense that we kind of are aware of that? And then we've got the downslope on the relative strength index saying it's underperforming. So we're on our third week of lower highs, not our second week of lower highs. So like the U.S. stock market, or in the U.S. stock market case, it's the first week. We actually made the high on the 1st of May. So as we go around the world, we're starting to see this. But my main point would be, when we have other markets set up so succinctly in the same sort of fashion, it does just suggest bigger caution. And so that's the backdrop, is that the rest of the world is also giving us a lot of these long-term weekly trend signals. And we just need to be aware, because I don't think the U.S. has been able to rally. It's back up to its prior highs on the S&P. Again, if you're in the NASDAQ or the New York Composite, you're actually on lower highs, and you're probably finding that if you weren't just perfectly positioned in tech, that your portfolio has been damaged somewhat, and you might not be back near the prior highs. Okay, so let's go look at some of the breadth indicators. And the point I want to make here is, so this is the NASDAQ Composite, and this is the NASDAQ Advanced Decline Line, shown two different ways. And so up here is the NASDAQ Composite, down here is the decline line, and down here is a moving average of the decline line, because the decline data actually just chops back and forth. And so what we do here is we add all of the uptrend. We add data on up days and subtract data on down days, and that's how we get this profile. And what's really interesting is how smooth a trend line the market made in a lot of these situations. And in this one, it pulled back for a month, but it wasn't that damaging. In this particular case, the 2018 high, the breadth indicator cracked with it and marked a meaningful break. And if you just look, this broke kind of the 29th of January, and here we are. That would have put you up here, not down here, when this trend line broke. Well, in this case, up here, we have another trend line break right here in October. And it lines up pretty well with the advanced decline line break. So they actually broke at roughly the same time. And now here we have the advanced decline line breaking. And again, this is a daily chart. So it's broken this 4-month uptrend, or pretty close to 5 months. But we're sitting here right now breaking it. And again, we're in the sideways consolidation, so it's hard to say it's broken. But without question, we're testing it at a pretty meaningful place, with a lot of trend lines snapping at the same time. Okay, so if we go to the NASDAQ high lows, and what we're starting to see here is we're at -5. So if we're in a big bull market last week, and yet we're hitting this -5 level, that's pretty low. And again, my main point here is, if you go back and look at 2014-15, we had trouble making a lot of net new highs, whereas in 2016-17, we were making a bunch of them. We were making them in basketfuls. And, there was a huge bull market, and this was the run. Well, since this September top, we haven't really got back into that big bull market mode. So even though the market's made new highs, very few stocks have made new highs with the market. And so here we are sitting at 0 or -5 while we're a couple of days off the high. So that what this number means is that there were more new lows than new highs by five individual stocks. But the bigger point on that whole thing is just that we haven't been able to get this breadth thrust where we had a lot of stocks participating. So as we've made new highs, it's been a small group or a smaller group of stocks actually pushing things up. So that's a big concern to me. And one of the things that I've been trying to flag on this Market Buzz show is to make sure that you're aware that the breadth setup is nowhere near the same. And the optimism being talked about by people who manage a lot of money is that they don't want to see money leave their portfolios. And so the breadth data is telling me that the market is not nearly as robust as the commentary is. And so I'm way more cautious right now. And so here's the New York Composite. And again, I showed you the charts of the New York making lower highs, and that's this up here, the New York Composite. It's making these lower highs. And you can see this 13,000 level is a pretty important friction level that it hasn't been able to get through. But on the advanced decline line, we had this nice big massive thrust and then this big pullback, and now we're in negative territory again. And that's not that scary. We've had this dip before, but the difference is now all of these trend lines are starting to break. And at this point, we had a very steep one. But I will point out that, the slope of this trend line, and this trend line are a lot more similar than a slope of a straight up trend line. So the advanced decline line slope, I would say, is on plane or very close to the previous advanced decline slope lines and is now starting to crack. And again, we get good news out of China. This could all just bounce back up and it'll be one of those little blips that didn't matter. But lots of things are being set up that suggest this is breaking. I'm actually going to go to the next one here. So this is the Dow Jones new highs, new lows. And we see this same thing that we've seen on the NASDAQ, where the percentage of stocks on the New York stock market that are making new highs, there's a group of them and they're great and we could probably name them. But the bigger issue is that they're really not getting the wide breadth thrust that we would normally want. So let's just say this China trade deal goes through and the whole thing starts to rally. This is probably the chart where we're going to start to see it first. We're going to start to see these big kicks in enthusiasm up above this trend line. And again, one probably doesn't make it, as you saw in the previous NASDAQ chart. But if all of a sudden you're starting to get these like week after week, that would suggest to me we're returning to a big new bull emphasis, and I'd probably want to be way more bullish than cautious. So to me, just sitting here with only 30 stocks making net new highs, and up here is a ratio, or not a ratio, a moving average, because again, this data, as you can see, is spiky and goes back and forth every day. Hard to make a real trend out of it. The moving average basically compiles it, and what you see here is one of the lowest compilations going all the way back into 2014. And so even though we've just come through a 30% rally or something, we off the lows, we've been sitting here and really struggling to get much more enthusiasm. Now, 106 is still a good number. It just doesn't get us up into this ballpark of great enthusiasm. And so, if you're in the right 100 stocks, you're probably doing okay. And if you're trying to be a value investor, you probably haven't made any money. Okay, but the point I want to make to oppose that point is the McClellan summation indexes and the McClellan oscillator. So what is the McClellan oscillator? So it oscillates back and forth on a daily basis, and the summation index takes that data and adds it up together in a cumulative, much like we do with the advanced decline line. And so it takes this data and summarizes it. And when you're at a really high level, like up here at 800, it would be very rare for us to make new market highs while that happens. And so, as Tom says, none. But the big thing is if it dropped down below 400 or 500 or dropped below it, then rallied up and couldn't get above this 500 level, kind of like it did in here, that was probably a great clue that the market was topping out. So with that, this summation data, both for the New York and for the the NASDAQ. In both cases, it's at very high levels. And this arrow does not refer to this red box. That red box sits here all the time. This arrow suggests that we've seen this sort of plunge way back here in 2009, and we had a meaningful pullback at the time, and you can see it was at a pretty important place too. We were trying to break through prior peaks, and then we did, and off we went. So we have one example of that kind of thing happening. There was this one in 2012 that we were at a very high level and we pulled back pretty darn hard, and that of course is what started the Fed. Well, this chart didn't start it, but we started the Fed entering quantitative easing infinity back in that period there. So we had this huge summation index, and all of a sudden it plummeted all the way to the very low side of the scale. And then the Fed stepped up with QE. So all of these peaks in here are pretty much irrelevant because they were, you were adding trillions of dollars to the market to make sure everything went up, and it worked. In 2016, we had kind of a rattle and a shake at this high level and fell all the way down, but it was only a marginal break. And then the market pushed through these prior highs, so kind of like what we're trying to do right now, and then it took off. So the setup is here, but we don't have conclusion on the setup. So I was hoping to get through this stuff a little bit faster, but I want to make sure I'm thorough with it. And maybe just as we're wrapping up here, I want to point out this is the bullish percent index for the New York Composite. And if we go back and look at 2007, we struggled to get above this 65 level. And then we pulled back. So we had these great rallies, and look at where the percentage of stocks above the 200-day stalled. It stalled, quite a bit lower. And the problem with where it stalled was it was roughly the 60% level, and that was as the market made the new highs and then pulled down, and the subsequent rallies didn't get much higher. Well, we got all the way up to 65, so that gave us some bullish enthusiasm, but you can see up here on the summation index, we didn't get much better than we have been in that big cycle. So this suggests to me that we're still in a condition where this market could easily break down. And if you took today's percentage of stocks that are above the 200-day moving average, we're at 58% of them. Well, that's right back down to where we peaked. So we were marginally higher than that. And then for us to roll over, this has happened before. And so that's my main point, is that while everybody's so bullish out there, at least be aware that we've actually seen this setup and we ignored it. And so if we go to the NASDAQ 100, I think this is an interesting chart. We had 85% of the stocks on a buy signal. We now only have 69% of them. And that's a big deal because you have to move the stocks a long way to get from a buy to a sell signal on point and figure chart. The second component here is that in this level got up to, 70% of the stocks above the 200-day moving average. That is very similar to where we were at in October of 2007 as the stock market topped out, and we were up even a little bit higher, so same kind of range. And then the pullback was quite immediate, and down we went. So one more chart that says that. So that's both the NASDAQ and the NASDAQ 100 and the New York Composite. The NASDAQ Composite is actually a little bit worse. So let's go to the S&P 500. And the point I want to make here is this got all the way up to 80, and that is very bullish. And even in October 2007, the S&P only got up to 70, which is currently where we're at. But I will say after that point, we dropped down and we spent a whole bunch of time below this level. Well, we have been below this level for a while, so making this kind of topping structure, and we had a brief surge, and now we're pulling back. Look at what we did in the January brief surge as the tariffs were announced. We were way up at this level and we shot all the way down, and that marked a meaningful decline that we all thought was painful. So thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific on Stock Charts TV.